Well, the Bank of England, like our European counterparts at the ECB and our American counterparts at the US Federal Reserves, have decided to pause hiking interest rates any further, holding the base rate at 5.25% against the expected rise to 5.5%. This followed a tightly contested vote amongst the bank's MPC, Monetary Policy Committee. It was a tightly contested vote, as I say, a split vote, with the ninth vote to pause rates 5-4 to hold the base rate at 5.25% was won by a split vote 5-4, with Andrew Bailey, the governor of the Bank of England, given the decisive ninth vote. It was, of course, Andrew Bailey who was slow to preside over his response to inflation entering the economy in the first place, describing it as a transitory problem that would sort itself out in the near future. His then aggressive rate rises summoned the longest real terms squeeze in living standards in modern day history. But as I say, the MPC were not worried, because just 2 days before, inflation data that came out from the previous month showed a 0.1, an unexpected 0.1 percentage point drop in inflation to 6.7%, the headline rate from 6.8%. And as I say, this was unexpected because many forecasters were expecting inflation to rise due to the rising cost of oil and gas, with the average price of a barrel of oil reaching up to $95 a barrel or even $100 a barrel, as Saudi Arabia and Russia withhold supplies from the global markets. Of course, now as well, wage growth has outstripped inflation, and in real terms, wages are growing faster than inflation. But the bank are not worried about this because their research suggests that inflation was never driven by wages in the UK economy, despite their claims and rebuttals about increasing public sector pay. That would be inflationary, but actually inflation was mostly driven by corporate profiteering and supply chain problems that cemented the UK's vulnerability, particularly in the energy market. This begs the question, was the pain really worth it? Especially at a time when even now 30% of the impact of rate rises has not fed through to the economy, because the effects of interest rates operate with long and variable lag times. And only a third, on the other side for savers, only a third of the interest rate rises are being passed on to savers. So savers as well are not getting their value for money. Though this will boost consumer sentiment in the short term, as Andrew Bailey said, there is no room in the near future for interest rate cuts. And despite the 11 billion extra headroom now given to Jeremy Hunt, he says there is also no room for tax cuts in the near future, despite these positive forecasts. This begs the question, is it the beginning of the end? Or is it the end of the beginning, where we see a much higher, much more inflationary world than we are previously used to?